Big lenders in big danger. I'm your host, Steve Van Metre, and thanks for joining me today. And America's biggest mortgage lenders are facing risks of defaults, delinquencies, and risky loans as recession looms. Let's over to CNBC where we picked today's story up. It's bad enough mortgage rates are over 7%. Now it's even harder to qualify for a home loan. It's a double whammy for would-be home buyers. Not only are interest rates soaring, but it's getting harder to qualify for a loan. And this doesn't make a lot of sense at first because most people think that if rates go higher, that banks will want to lend. We'll talk about why they don't in a minute, but I want you to be thinking is, what is keeping banks from wanting to lend at higher interest rates? It'll surprise you. The average rate on the popular 30-year fixed mortgage climbed over 7% at the end of last week, and it's been over 7% for several days. Meanwhile, mortgage credit availability is now at the lowest level since March of 2013. And what this means is the amount of pool of money available to lend to mortgages is shrinking. It's small. So not only are banks not wanting to lend, the amount of money available to lend is really small. And that doesn't make a lot of sense, but it will in a moment. Which was when housing was in a slow recovery from the financial crisis at the end of the prior decade. It fell for the 7th consecutive month in September, down 5.4% in August. So what I want you to be thinking as we go into this next chart, now there's two factors here. One, we don't have the data on mortgage tightening from the Fed database. It is spotty and inconsistent at best. But what banks lend, they borrow at the short end of the curve and they lend at the long end of the curve. So when you see an inverted yield curve, where short-term rates are higher than long-term rates, what we should expect is not only banks don't want to lend, but the amount of money to lend is shrinking, and now it starts to make sense. Let's take a look at this chart here where we see the net percentage of domestic banks tightening lending standards in blue. And we'll note that when the blue line rises above the black line, it means lending standards are tightening. Now in the red, we have the yield curve with the baseline here in this crudely drawn yellow line. And the curve is inverted. The red line is inverted when we see it below or at that yellow line. And notably, when the curve inverts, what we see the banks do is they tighten lending standards. They see it happen every time. Now, what's more important is not just that lending standards are tightening now, is that we'll go back and look at a moment, is when the yield curve steepens, what happens is lending standards get even tighter, meaning as rates go back down, banks still won't want to lend. In fact, they'll want to lend even less than they are now. And here you can see as the curve steepens, lending standards will continue to tighten. While lenders may be desperate for business as mortgage demand drops due to higher rates, they are also more concerned about a weaker economy, which could lead to higher delinquencies. Executives and economists have warned the U.S. could fall into a recession in the coming months as the Federal Reserve hike rates to battle high inflation. And so the big issue that these mortgage lenders are facing, particularly the non-bank lenders, and what their business model involves is originating new loans, packaging them up into bonds, and selling them on the open market. No new loans, no repackaging, no profit. Now for the other banks, those who are holding onto these mortgages, the risk now of delinquencies and defaults, particularly to the bondholders, and if they're not the banks, they're the investors out there. And of course, we note that the Fed is busy unwinding its mortgage-backed securities off its balance sheet, and while it still remains one of the largest holders in the world, is quickly trying to find a way out of that job. As demand now for riskier home loans is high as interest rates soar, another story which almost doesn't make any sense. Why are people out taking risky loans? Well, the average rate for a 5/1 ARM, which is an adjustable rate mortgage that has a fixed rate for the first 5 years, increased slightly, but was still lower at 5.56%. Get this, the ARM share of applications was just under 12%. When rates were lower earlier this year, it was barely at 3%. And while ARMs can be fixed for up to 10 years, they're considered riskier loans because the rate eventually adjusts to the market rate. And rates have been low for long, and that before rates started to rise, borrowers didn't need to take on that additional risk. But what's likely to happen now for people that are taking these ARM loans is they're probably thinking that in 5 years, I'll refinance when rates are lower. But as we just talked about, unless somehow there is support from the government government or some crisis where we see an intervention by the government, when interest rates go down, lending standards are going to get even tighter. And what happens now if we hit a recession and home values come down, that these people holding these ARM loans are going to be stuck with whatever rate comes down the pipe. Of course, the reason they're taking the ARM loans, they can't afford the payment on a fixed rate, leading us to potentially a big problem in the mortgage industry. But not to worry, of course, there's no chance the recession is going to be long or deep. And here we see from President Biden says very slight recession possible and downplays the risk. President Joe Biden said a recession in the U.S. is possible, but that any downturn would be very slight and the U.S. economy is resilient enough to ride out the turbulence. He said, quote, "I don't think there will be a recession. If it is, it'll be very slight recession. That is, will move down slightly," he said in a recent interview with CNN. Now, what do you think? Do you think he's right? Will we just see a slight recession? Will we see a deep recession? Perhaps no recession at all? I'll let you weigh in the comments. Asked flatly if American people should prepare for a recession, Biden replied, no. Yet Bloomberg Economics recession probability model in September reported to a 30% chance of a downturn starting inside the next 12 months. Although that model-based estimate may understate the risk when accelerated Fed tightening is making a recession a high probability. And there's no doubt about that, because we can look back in history and see periods where you see a rapid rise in interest rates or a rapid tightening cycle by the Fed or a rapidly rising dollar, and they all lead to some form of crisis. But one thing that shouldn't be facing a crisis and should be prepared for a recession is your portfolio. I'll put a link up here to Portfolio Shield and description below, because according to former Fed Chair Janet Yellen, now Treasury Secretary Yellen, the dollar is going to keep screaming higher, and that is bad news. Yellen's endorsement seals seemingly unstoppable dollar rally as U.S. Treasury Secretary's view is a big tick for dollar bulls. The greenback rose versus most of its group of 10 peers on Wednesday after U.S. Treasury Secretary Janet Yellen said the currency's strength is a logical outcome of different global monetary stances. Strategists say Yellen's nod for a strong dollar will help power more gains in the world's reserve currency. So I want you to see, as a policymaker, she's saying the divergence between the Fed's move to drive rates higher and other central banks not to fall as quickly is causing the dollar to move higher. But yet in that same article, the person writing it kind of picks up on the real story, which we've been making the case. And of course, yesterday we talked about how the Swiss National Bank had to borrow $3.1 billion from the Fed on a short-term loan, suggesting that the real problem is a dollar shortage. A 4-month advance in the dollar is showing few signs of slowing, although some strategists warn that rising interest rates will soon start to hurt the U.S. economy. The impact of the stronger greenback is being felt across the globe as developing nations struggle with heavy dollar debt load and pricier imports. And there you get to the real story is there's a dollar shortage and a lot of dollar debt, and that's what's driving the dollar higher. And for chip makers, particularly Intel, this is bad news and looks like there's going to be more layoffs and lower stock prices and a recession in our future. As chip maker earnings estimates fall flat at the fastest pace since 2008. Having gone from boom to bust, a headline that will make its way in a matter of months to the broad economy. In less than a year, the semiconductor industry is now bracing for a storm that's expected to hit everyone, from producers of memory chips to semiconductor equipment makers and manufacturers of computer processors. The slowdown is dramatic and pointing towards rapidly deteriorating demand for consumer electronics, although mostly a headline I think we'll hear central bankers using in the months to come when referring to the economy. And that leads to Intel planning thousands of job cuts in face of a PC slump. And this is something we've talked about on this show, that when you start to see new orders or demand fall, that the response to that will eventually be layoffs. And here, let's take a look at this chart from the Philly Fed, looking at current new orders, the diffusion index in blue. So you can note that when the blue line falls below the black line, that means there's a contraction in new order demand. And in red, we've got the 4-week moving average of initial claims. And sure enough, that when we see new order demand fall, not initially, but then the reaction is we see initial claims starting to rise. And here we are now hearing from Intel saying, look, demand is down, so we're going to start laying off, and that's going to flow through to the broad economy, raising the risk of a recession. But one thing that is going to see some improvement now is pricing, at least at the producer level. Wholesale prices rose 0.4% in September, more than expected, as inflation persists. The Producer Price Index, a measure of prices that the U.S. businesses get for goods and services they produce, increased 0.4% for the month compared to estimates of a 0.2% gain. On a 12-month basis, PPI rose 8.5%, which is a key here, slight deceleration from 8.7% in August. So we're seeing early signs of disinflation. Let's keep going. Excluding food and energy and trade services, the index increased 0.4% for the month and 5.6% from a year ago. But what is the biggest driver of producer prices? Well, it's the input of WTI, or West Texas Intermediate. Check this chart out. Because we can note that producer prices are likely to head back down. Now, this means the rate of growth. It doesn't mean we're likely to see prices go lower. What it means is the rate of growth is likely to come to a halt in the future, as we note that WTI in red overlaid with the producer price index, final demand in blue. As the year-over-year rate of change in crude oil heads lower, we should see in the months to come producer prices also following. Now, I want to follow up to yesterday's story as Bailey sends shivers through fragile global bond markets as the Bank of England governor reiterates emergency bond purchases to end on Friday, putting the big question is the central bank bluffing? Well, the market's going to bet that it is. The global message may be that markets must unwind trades that are going to fail anyways as rates rise and stay high with a brief central bank backstop. Perhaps the BOV is sending the united message that the game has changed, Volcker style. The central bank has already seen its credibility called into question after a lackluster initial response to rocketing inflation. Now Bailey finds himself boxed in. If he holds a line, the UK could see another punishing surge in bond yields that would cause more economic damage. If he backs down, his reputation will be in tatters. Cross-Border Capital tweeted that the Bank of England, are you crazy? Bailey has just delivered the shortest suicide note in monetary history. The central bank has just left the market to malfunction when it was the main cause, as I pointed out on this show. But now you can see what's going on in the mortgage industry with rising rates and weakening demand, on top of the fact that banks are tightening lending standards. It's begun to be the perfect storm. Non-bank lenders should be closing their doors in the months to come, and those holding the bag with these mortgage loans, the big banks potentially could be facing delinquencies and defaults, which will hammer their bottom line. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.